Well, hello and welcome. Thank you so much for your feedback, everyone here on YouTube throughout the week. People encouraging me to continue to provide the videos. You're enjoying it, getting a lot of content out of it, and you also enjoyed how I set the trade up in my brokerage account, Interactive Brokers as well. So I'll certainly include that this week. Now, the position that we had on with GOGO, let's just go to that quickly. Close it out now, right? We set up a bearish position here by buying the 16 put, selling the 14 put. We can close it out now for a 21% return in 2 weeks. So just go ahead and close that trade out. One trade that we did mention last week, or the week before, should I say. Close that out now, and we will lock in that profit. Now, the other one that we spoke about was RIOT. Right now, with this one, it is looking really good. I believe it will stay above $5. We'll keep an eye on that. And that is one there that is obviously linked in with Bitcoin and blockchain. And I believe if it stays above $5, we will make that 14.1% return. Time will tell. Now, why do I say that? Well, let's just have a quick look at Bitcoin. I'll just give you my thoughts here. We've got a 1, 2, 3. We've got maybe a triple bottom happening here at support at around 19,500. So about 19,500 support level there. Quite strong, holding well, and maybe a triple bottom there. Just over 21,000 a coin right now. And we could be seeing a bit of a bottom now in the crypto market. We don't know exactly where the bottom is. No one knows exactly where it is, but I think we're close. Okay, this technical level at 19,500 is holding. That's one thing. The Bitcoin price is below its realized price line, and that normally indicates a bottom in the crypto market. You're getting the realized loss ratio spiked above 1% of market cap. That's also consistent with a bottom in the crypto market. And the percentage of supply in profit is only around 50%. And that again is normally consistent with a bottom in the crypto market. So we'll see. We'll see what happens. There may be some more pain here yet before we then move higher, but we are close, I believe. Okay. Now, having said all that, let's look at the overall stock market now. And yes, we had a nice move up on Friday, and we've set a new opening range. Okay. So if we have a look here at the opening range, we've just set that on Friday. Why? Because it's the third Friday of the month. It's monthly options expiration. So 3863, if it closes above that, we are in bullish opening range mode. If it closes below 3817, we are in bearish opening range mode. Now that's really important. Write that down. 3817 bearish. If a daily close below that level on the SPX, we are bearish. Why? Well, mainly because of these points, these market internals that I check, which mathematically measure human insanity in the market, right? Turning points in the market. The combined put-call ratio is a 10-day moving average is at 0.92. Something between 0.8 and 0.95 is neutral. So right now, that one's not really telling us anything. If it was under, if you saw this under 0.75, that would be bearish, or above 1, that would be bullish. But right now at 0.92, it is neutral. The skew, the perceived risk of a market crash, if it's below 115, then that's bullish. If it's above 135, it's bearish. So right now, in between 115 and 135, that's neutral. So two neutral readings. But the trend, the most accurate overbought, oversold reading in the stock market, much more accurate than RSI, which can remain overbought and oversold for long periods of time, when you're getting a trend reading under 0.5 or very close to 0.5, you can see it right now at 0.5 right there, that is bearish. 90% of the time, not 100, but 90% of the time, you will see the markets move down over the next 1 to 3 days. So that's a bearish sign. That's something that I'm paying attention to. The SPX put-call ratio, it's 1.3 right now. Anything below 1.75 is bearish, showing excessive call buying. So this is a bearish signal. The amount of, when we look at the market momentum, the amount of stocks below their 50-day moving average is at above their 50-day moving average is 37%. If it's below 50%, that's normally a bearish sign, right? It's a very poor market momentum there. Now, if we look at the other indicators, we go to our MA, our moving average trend. This helps us to determine the trend of a stock very quickly and very easily, or index, or whatever you're looking at. So first thing I'll look at is junk bonds. So if we look at junk bonds, you can see when they're stacked like this, 89 on top of the 55, on top of the 34, on top of the 21, on top of the 8 EMA, when they're stacked in that sequence, that's a downtrend. So right now, junk bonds, which really in a healthy market, when people are willing to take risk, you'll see junk bonds go up. But right now they're moving down, so that is a bearish sign. Even high yield corporate bonds are down as well. Again, same sort of thing. People are not looking to take risk in the market. Both the junk bonds and the high yield bonds have come up to fill this gap actually. So, but certainly bearish right now. We look at Goldman Sachs, so goes Goldman Sachs, so goes the market. That is in a downtrend as well. They're all stacked bearishly, right? We can clearly see that they're all stacked bearishly as well. Okay. And if we then look at the transports, the transports are good to look at because obviously they're stacked bearishly, but they can tell you where the market is likely to move in the weeks or months ahead. So right now we're still very much bearish right now. So 8 out of the 10 points that I use to tell me when the market's likely to fall, and I've used this many times to great success, right now they're telling me they are bearish. Okay, so the only thing that I need to really get bearish and start buying call options on inverse ETFs and put options on specific indexes and go long volatility is for the SPX opening range or the SPX itself to close below 3817, a daily close below that level. If it does, I will start to do exactly that. Long, so call options on inverse ETFs, put options on specific indexes, and long volatility. That's what we're going to be doing. So we're going to be monitoring that throughout the week. News coming up this week is mainly around housing. Okay, they've got the housing market index, permits, building permits, housing starts, existing home starts, a lot of housing going on. Unemployment, that'll be something that the market looks at as well. A bit of manufacturing as well, but mainly around housing. So we'll keep an eye on that. We know that what happened last week, 9.1% inflation rate, the highest in 41 years. That will lead to further rate increases. So we'll see. And maybe the housing market is cooling off a little bit as well. So we'll keep an eye on that. But for me right now, I think the big banks away, bond sales and risky market. Yes, US credit week ahead. I think some of the big banks are starting to feel the pinch here. It could be a lot of people defaulting on mortgages and all that type of thing as you start to see the housing market cool off and rates go up. The actual rate that you pay with your mortgage in the United States is like doubled in just a very short period of time. So for me right now, if I was looking at a position, something like JP Morgan, who reported pretty average earnings and very average revenue, but its earnings per share were less than expected. They expected $2.85, they reported $2.76. So earnings weren't that good, revenue was just average. And if you look at the actual chart, we look here at JP Morgan. You can see here JP Morgan right now is certainly in a downtrend. Okay, it's below the 21, the 50, the Ichimoku cloud, and the 200. Okay, when we look at it with just the price action itself, we can see that it is in a downtrend and a little mini downtrend here as well. So certainly in a downtrend right now. The OBV, what's that? The on balance volume is certainly in a steep downtrend. When you're getting the on balance volume in a downtrend, it shows you there's excessive selling pressure. So selling pressure exceeds buying pressure. Not a specific number, but when you actually get it in a downtrend like that, a lot of selling pressure right now, certainly exceeding the buying pressure. So downtrend there. We're seeing, if you looked at the sectors and you look at financials, you can see they've been moving down pretty considerably as well. So I like to look at the stacked moving averages, which helps us to determine the trend. We can see that it's certainly stacked in a bearish way, right? 89, 55, 34, 21, 8 stacked in that sequence. It's a downtrend. That's why you determine a trend very quickly, very easily. And what we want to do, though, is get a big picture here. So we look at the SPX. Okay, so that's certainly stacked bearishly, right? And if you just out of interest, I'll just show you this. The on balance volume is certainly moving down on the SPX as well. Again, selling pressure exceeding buying pressure. But back to the stacked moving averages, SPX stacked bearishly. We look at XLF, which is the sector that JP Morgan belongs to. That's stacked bearishly. Then we look at the index that JP Morgan belongs to. So not the index, the industry. So we've got the index, the SPX, then we've got the sector financials, both of those in the downtrend. The industry that JP Morgan belongs to, banks, right, global, that's moved down as well. That's in a downtrend, very clear downtrend. And then finally, the stock itself, you can see that that's in a downtrend. So when you're getting money flowing out of an area of the market, you want to look for bearish opportunities within that area, right? Money's flowing out of that area, right? Flowing out of the index, flowing out of the sector and the industry and the stock. They're all in a downtrend. They're all doing the same thing. That's what you want to look for, right? Consistent money flow in one direction or another, in this case, to the downside. So having said all that, I think setting up a position here on JP Morgan would make some sense. Don't want to take a lot of risk, okay? But let's have a look at this. We can set up a high return vertical spread here where with a price right now, 112.95, okay, as of today, expiry the 19th of the 8th, 61 days, the expiry, should I say, is, let me just get this right, is the 16th of September, right? 61 days from now, right? 16th of September is the expiry. Monthly options expiry in September, 16th of September, 61 days from now. Now, our goal is for this to finish below 105, which I think it could easily do. But again, we need to be prepared in case it doesn't, right? Which we will talk about that in a moment. The risk. Always manage the risk first. The returns will take care of themselves. So, the aim, what are we trying to achieve? Well, we're looking for the stock to move below 105. Where is it now? 112. Okay. So I'm going to buy the 110 put, sell the 105, both with the same expiry, 16th of September. Okay. That will cost me $1.53. Now, you could increase that to get it filled. I wouldn't go past $1.80, but $1.53, right? The max value of the spread, the difference between the bought strike and the sold strike, 110, 15, $5, minus what you paid for it, $3.47 is a potential upside, right? That's a 227% potential reward on risk without using a stop, right? Now, the break even, where does it need to go below for me to be making money at expiry? When's expiry? 16th of September, right? You look at the buy strike price, 110, minus the premium, 153, is $1.08.47. So it's 108, should I say, $108.47. If it's below that at expiry, you will be in profit. So I'm going to set my stop at $83 a contract. We entered for 153 or $1.53, set it at 0.83, 83 cents, right? So we're risking 70 cents here with that stop for a potential upside of $347 or $3.47, right? Times it by the option multiplier of 100, 347. So our potential profit is almost 5 times higher than our risk. 5 times higher than our risk. That's asymmetrical risk working in your favor. It's the only way to make money in the markets, right? So asymmetrical risk working in our favor, almost a 5-to-1 risk to reward. All it's got to do is move below 105 in the next 61 days. And the worst case scenario is we lose $70 a contract, right? So we know what the worst scenario is. We know what the potential upside is, 5 times more than what we're risking. We've looked at the money flowing out of the market, out of the index, the sector, the industry, and the stock, and we're setting up a high probability vertical spread to monetize what's going on. So I hope you guys found that useful and enjoyed it. You learned something from it. I'll talk to you again next week. If you've got any feedback, send it to support@cashflowoptions, all one word, cashflowoptions with an s.com.au, and we'll be happy to hear from you. All right, my friends, all the best and bye for now.